Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 3. This is Section G, and we're actually going to be covering two topics. One is a remembering and understanding topic, and one is an application topic, and I kind of just mixed them both together. We're going to learn how to identify subsequent events and calculate required adjustments or note disclosures. And again, these are two topics in Section G of FAR Area 3 that I'm kind of combining because they're very similar, so we're going to be going over both of those today. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. If you don't know much about our strategies, that is one of our biggest strategies, is going straight to the questions to learn, because what are you going to be doing on test day? You're going to be answering multiple choice questions and sims. So why not get good at that rather than reading a textbook and watching video lectures? And if you want to learn more about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training where we go over the key ingredients to passing the CPA exam, and we will save you so much time struggling with these CPA exams. Also, just letting you know, after you check out that webinar, make sure you check out becoming a SuperfastCPA Pro member, because Pro members get access to this SuperfastCPA Pro course where Nate goes over in detail exactly what you're supposed to be doing every day to pass the CPA exams. And also, SuperfastCPA Pro members get access to the full 10-question versions of these 5-question YouTube videos. So if you like these YouTube videos and you want to get more of it, make sure you become a Pro member, because Pro members get access to the full 10-question versions of these videos. With all that said, let's dive straight into the questions. All right, here we are at question 1, and something I always like to point out in these videos is make sure you read the last part of the question first, because that will give you context for what you're dealing with in the question. And this is a really good test day habit and strategy, because you have no idea what you're going to be seeing on test day. So let's go ahead and do this. How should the company treat this event in its December 31st Year 1 financial statements? Let's go up to the top. A company completed its fiscal year on December 31st Year 1 and plans to issue its financial statements on February 28th Year 2. On February 15th Year 2, a warehouse owned by the company was destroyed in a fire. The warehouse was not insured and was fully operational. So with that information again, how are they going to treat this event in their December 31st Year 1 financial statements? If you have any idea how this works, that's great. You probably already know the answer. But if you don't know how this works, we're going to use these questions to learn how to do the material. So don't worry, we're going to look at the answer and we're going to figure this out. All right, here we are at the answer. The answer is B, disclose the event in the notes to the financial statements, but do not adjust the balances as of December 31st, Year 1. So let's walk through this. Again, we're talking about subsequent events here, so we're talking about how they're treated. This is an example of a subsequent event that provides information about conditions that arose after the balance sheet date. The destruction of the warehouse is material and would have had a financial impact if it occurred in Year 1. However, since the fire happened after year end and did not reflect conditions that existed as of December 31st, Year 1, no adjustment to the financial statements is required. Disclosure in the notes is necessary to inform users of the financial statements about this significant event. Basically, because this happened after the year end, but before the financial statements were issued, they are going to disclose that this happened in the financial statement notes. But again, because it didn't happen in Year 1, it happened in Year 2, and it didn't have anything to do with Year 1, then we don't need to do any adjustments or anything like that. There's only a disclosure and maybe the estimated cost that it's going to have. So that's one way you treat subsequent events. Let's go to the next question. All right, here we are at question 2. How should the company treat this event in its June 30 Year 1 financial statements? Let's go up to the top. A company completed its fiscal year on June 30th Year 1 and plans to issue its financial statements on September 30th Year 1. On July 15th Year 1, the company finalized a settlement for a lawsuit that had been ongoing throughout the fiscal year. Prior to June 30 Year 1, legal counsel had advised that the likelihood of an unfavorable outcome was probable, and the company had a reasonable basis to estimate the loss. So with all that information again, how are they going to treat this event on the financial statements? Is it going to be the same or different? If you've seen this before, that's great. You already probably know the answer. If not, let's go ahead and look at the answer together to figure out if this is treated differently. All right, here we are. The answer is A, they would recognize the settlement as a liability and disclose the event in the notes to the financial statements as of June 30th Year 1. So this is a different kind of subsequent event. There's basically two types. Let's walk through this one. The lawsuit represents a condition that existed as of the fiscal year end because it was ongoing during the reporting period. Legal counsel had determined the likelihood of an unfavorable outcome as probable, and the company had enough information to estimate the loss before the fiscal year end. As a result, the liability must be accrued in the June 30 Year 1 financial statements. The settlement finalized after year end confirms the estimate but does not negate the need for recognition. Additionally, the material nature of the settlement requires disclosure in the notes to inform users of the financial statements. Basically, again, this is a little bit different because this is a condition or something that was happening during the fiscal year that we're talking about. So it was happening before the financial statement close date on June 30th, Year 1, even though maybe the settlement didn't occur till after the end of the year. because it was something that existed before the end of the year, they are going to have to recognize a liability and they're going to disclose it in the notes. So there's that difference. If a subsequent event happens after year end, but before the financial statements are issued, then you disclose that in the notes, but you don't have to make an adjustment in the financial statements. However, if there was something that was happening before the end of the year, and then finally it kind of comes out and is being dealt with after the year end, but again, it was happening before the end of the year, then you actually have to recognize that in the financial statements and disclose a note. So those are the two different kinds of subsequent events that you usually are going to be dealing with. So with that, let's go to the next question and learn a little bit more. All right, here we are at question 3. When does the subsequent events evaluation period end for each company, and does the date need to be disclosed? So let's go up to the top. Company A and Company B both completed their fiscal years on December 31st, year 1. Company A files with the SEC while Company B does not. Company A's financial statements were widely distributed in a form and format complying with GAAP on February 15th, year 2. Company B's financial statements were finalized in a GAAP-compliant form and format and approved for issuance by the Board of Directors on February 10th, year 2. They were not widely distributed until February 25th, year 2. So with all that information again, when does the subsequent events evaluation period end for each company, and does the date need to be disclosed? So this is kind of a strange question, right? This is something that you'll need to know, but I kind of took a whole bunch of information and put it into one question because it's all really related and really simple. If you know the answer to this, that's great. If you don't, maybe pause the video and think through this, and if you want to give it a guess. But if not, that's okay. We're going to look at the answer together. All right, here we are at the answer C. Company A would have February 15th, year 2 as their date, but it doesn't have to be disclosed. And Company B would have February 10th, year 2 as their date, but that does need to be disclosed. So let's walk through this to kind of understand what we're even talking about here. For companies that file with the SEC, the subsequent events evaluation period, so the period where they're allowed to evaluate and see if there was a subsequent event, extends to the date the financial statements are issued, which for Company A is February 15th, year 2. Issued means the financial statements have been widely distributed in a form and format that complies with GAAP. So basically there's two parts there. It has to have been widely distributed to, all the users, and it has to be in a form that complies with GAAP. SEC filers do not need to disclose this date in the financial statements. So that's an SEC filer. They use the date that the financial statements were issued, but that doesn't have to be disclosed. Whereas on the other hand, for companies that do not file with the SEC, the subsequent events evaluation period extends to the date the financial statements are available to be issued, which for Company B is February 10, year 2. Available to be issued means the financial statements are in the form and format that complies with GAAP, and all necessary approvals have been obtained, such as from the Board of Directors. Non-SEC filers are required to disclose this date in the notes to the financial statements. So with all that information, we understand this last part. The later date when Company B's financial statements were widely distributed on February 25th is not relevant to the evaluation period because the company is not an SEC filer. So again, there's a lot of information in this one question, and you might see other questions that are kind of small parts of this, but I kind of wanted to cover all of it in one question. Basically, if you're an SEC filer, your evaluation period for subsequent events ends on the date that the financial statements are issued, and you don't have to disclose that date. If you are not an SEC filer, the evaluation period for subsequent events ends on the date that the financial statements are available to be issued, and you do have to disclose that date. And remember, issued means that it's actually been widely distributed and it conforms with GAAP. Available to be issued means that it's been approved and it conforms with GAAP, but it hasn't been widely distributed. So a lot of information in that one question. I hope that helped. Now let's go to the next question. All right, here we are at question 4. How should the company account for this event in its December 31st, year 1 financial statements? A company completed its fiscal year on December 31st, year 1, and plans to issue its financial statements on February 28th, year 2. On January 20th, year 2, the company experienced a flood at one of its facilities, resulting in damages to equipment and inventory. The total estimated cost of damages is $2,500,000. The facility and its assets were fully operational as of December 31st, year 1, and there were no indicators of impairment or issues with the facility prior to year end. So with all that information, how are they going to treat this? This is very similar to question 1, but now we have numbers. Now we have to remember how this actually works. I want you to pause the video, try to apply what we've learned so far, and when you're ready, come back. We will look at the answer together. All right, here we are at the answer. The answer is B. Disclose the event in the notes to the financial statements, but do not recognize a loss in the financial statements as of December 31st, year 1. So let's walk through this. The flood is an example of a subsequent event that provides information about conditions that arose after the balance sheet date. Because the facility was fully operational as of December 31st, year 1, the flood did not reflect conditions existing at year end. Therefore, no adjustment to the financial statements is required. However, the material nature of the $2,500,000 in damages requires disclosure in the notes to the financial statements to inform users of the significant event that occurred after year end. So again, this is one of the two different kinds of subsequent events. This happened after the balance sheet date, but it's still a really big deal, and it happened before the financial statements were issued. So they are going to have to disclose in the notes, hey, this happened. We have $2,500,000 of damages potentially from this flood. But again, they're not going to make any adjustments in the financial statements for year one because it didn't happen in year one. Now let's go to the next question. All right, here we are at question 5. How should the company account for this event in December 31st, year one financial statements? Let's go to the top. A company completed its fiscal year on December 31st, year one, and plans to issue its financial statements on February 28th, year two. On January 20th, year two, the company settled a lawsuit that had been ongoing since July of year one. Before December 31st, year one, the company's legal counsel had assessed the likelihood of an unfavorable outcome as probable and provided an estimate of $3 million for the settlement. The final settlement amount agreed upon was $3,200,000. And again, this lawsuit was settled on January 20th. So with all that information, how should the company account for this event? Pause the video, think about this, and when you're ready, come back. We will look at the answer together. All right, here we are. The answer is A. They would recognize a liability of $3,200,000 in the financial statements of December 31st, year one, and disclose the settlement in the notes to the financial statements. So this one might have been a little bit confusing because originally they estimated $3 million, but the final settlement was $3,200,000. The key thing that you want to pay attention to here is the fact that it settled the lawsuit on January 20th. So there was that estimate at the end of the year, but the lawsuit was settled before the financial statements were issued. So since they knew exactly how much it was going to be, $3,200,000, that's the amount that they are going to put in the financial statements. Because the settlement occurred before the financial statements were issued, it provides additional evidence about conditions that existed as of December 31st, year one. The lawsuit liability must be adjusted to reflect the actual settlement amount of $3,200,000. Again, that's what I was saying. This adjustment ensures the financial statements accurately reflect the company's obligations as of year end. Additionally, the event must be disclosed in the notes to the financial statements to provide transparency to the users. So with that, we've completed question 5. Now, before we go any further, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 3 or 4 questions trying to teach you the rules for SEC filers or the rules for non-SEC filers or whatever the case may be. You're going to notice these things as you're doing the questions. So you take a moment during and especially after you're studying and you write down these pillar topics in your own words so that you know what is most important for the exam. And as you do this each day, you're building your own personal repository of your own pillar topics in your own words so that you know what you need to know for exam day. Now let's go to the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive in. If a subsequent event provides additional evidence about a condition that existed as of the balance sheet date, such as a known lawsuit confirmed after year end, so they knew the lawsuit was happening and then it's confirmed after the end of the year, the company must disclose and accrue the liability in its financial statements. So again, if it's something that was happening or had happened before the end of the year, and then they kind of get more information about it after the end of the year, that is a subsequent event that is going to be disclosed and accrued in the financial statements. However, if a subsequent event happens after the year end, but before the statements are issued and it does not reflect conditions existing at year end, it is disclosed, and so that would maybe include the estimate of the financial impact, but it is not recognized in the financial statements. Now let's talk about issued and available to be issued and SEC and things like that. Issued means the financial statements have been widely distributed in a GAAP-compliant form and format. SEC filers use the date of issuance to end their subsequent events evaluation period, and they do not need to disclose this date. Now, available to be issued is a little bit different. This means the financial statements are in GAAP-compliant form, and all required approvals, such as from the board of directors, have been obtained, but it doesn't mean it's been distributed. Non-SEC filers use this availability date to end their subsequent events evaluation period and must disclose this date in the notes. So those are kind of the big things that you need to know about this topic, about subsequent events and how to calculate them and things like that. It's not too difficult, so hopefully these pillar topics are helpful. And with that, we finished the 5 questions for this YouTube version of the video. If you liked it, make sure you remember that SuperFast CPA Pro members get access to the full 10-question version of the video, which I'm about to start recording right after I finish this one. So if you like this, become a SuperFast CPA Pro member. You get access to a ton of great materials, including the Pro course and, of course, these 10-question videos. And if you want to learn more about SuperFast CPA in general, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. We will teach you the key ingredients to passing the CPA exam. Make sure you check that out. With all that, I hope you liked the video. If you did find it helpful, make sure to like it and leave a comment on the YouTube video. And with all that, I will see you in the next video.